Very good. So according to my official phone, it looks like it's 5:30. So not that there's anything super exciting what I'm going to say, but it's so. What I decided to focus on today is to try and frame the current debate essentially in this idea that what we've encountered in recent months is essentially surprise inflation. And a lot of models of inflation are basically zero in on steady state inflation, expected inflation. So when you have a surprise inflation that was not expected, how to think about that issue. So that's basically how I'm going to try and use my time. And of course, I'll end up with the monetary policy implications of that. So this graph I've been showing in recent times, and it's updated from yesterday. So it starts at the start of 2020. And so at the start of the pandemic, we were concerned that the pandemic would essentially be a negative shock for inflation. Not only negative in the kind of immediate impact, but also because we also, even though I don't show it today, but we also had a projection that the pandemic, yes, there would be a recovery. By the way, the staff more or less concluded that it would take about 2 years for restrictions to ease. So around now, and that's more or less the timeline for a vaccine, a medical solution to be found, and for life to go back to normal. But we did project that there would be a fair amount of slack, that there would not be a complete recovery. There would be hysteresis, and the inflation environment would be dominated by the fact that with kind of being well below potential output, it would not be a very inflationary situation. So that's in the, I don't know how well you can see it on the chart, the initial projection from June 2020 is the red line at the bottom there, which says not only would be inflation low, it would remain quite low throughout the projection horizon. So that's part of the motivation for the PEP, for Teltras and so on, is not only the initial stabilization role, but also if you believed there would be a lot of slack in the system, extra monetary support would be needed. Okay, so, and in fact, in mid-late 21, inflation was a little bit negative. And so what happened then in the first half of 21 was basically inflation started to pick up, but the fact it was still in the ones, only approaching 2 from below, was essentially nothing too dramatic. And so let me go to the green line. So that's September 21 projection. So by September, inflation was above 2%. And now we had a situation where the projection had, for the first time in a long time, a period when inflation would remain above 2% for a while. But then it remained the case in the September projection, which is not that long ago, 9 months ago, what was that inflation would subside, and would subside not only to 2%, but well below 2%. So I think that the 2-year ahead forecast was around 1.5, even in September. So the diagnosis was, in the medium term, your area still had this low inflation probability. So then what I show next is December. So December inflation was already around 4. And actually when we came out, or the staff came out in December, with a projection that inflation in 22 would be 3 point something, is well ahead of the market. People are saying, "Oh, you think we think inflation will recover much more quickly than that," and so now everyone caught up pretty quickly. But that had, again, a fair amount of time being above 2%. Then we go to March, where inflation already high, and again the revision is an extended period of above 2% inflation. But even in March, the assessment was, when this shock fades away, Europe would still have marginally a low inflation problem. I think in March, the end of horizon projection was still 1.9, not quite to 2%. And of course, what's happened then is today the current inflation rate has continued to climb. So this includes yesterday's flash number for May, which is above 8%. I don't show you next week's forecast. Sorry about that, but you'll have to wait for next week. So what this says is this has been a surprise. And I show the ECB here, but broadly speaking, the world of professional forecasters, they look very similar. So repeatedly being surprised. So there's really two forces at work when you have that sequence of surprises. Either there's a sequence of shocks, or you don't understand the propagation mechanism fully. So the shocks that had occurred have a momentum or a dynamic that that series of forecasts did not capture. And it's going to be obviously some mix of the two. I'm not going to try and give you an exact decomposition. Okay, so that's my starting point. My second point is, of course, it's important to analyze what are the shocks, what are the forces driving this. Now, that might look like one chart from a distance, but in fact, it's two charts. Because if I try to put the energy inflation rate on the same as everyone else, it would give you a very particular perspective. So the chart on the left is there's energy, which is basically May to May at basically 40%. And if you go back over the history of kind of surges in energy inflation, this is a big number. Let me just recollect for you, for those who don't spend all day, every day looking at these things. Energy directly is about 10% of the price index. Food is about 20% of the price index. So then the other chart is all on the same scale. Overall inflation around 8. Food nearly up to the same level now. So food inflation, and food is about 20% of the price index. Then I have the core or HICPX, the light green, which is a nudge below 4, but still pretty high by historical comparison. And unusually within core, you have goods prices being stronger than services prices over the last year. Historically, manufacturing prices have been dropping in relative terms for the last 20 years at least. But in this period, you've had a surge in goods prices. So the nature of this shock or series of shocks has this kind of a categorical asymmetry, at least so far. Okay, so next, I want to think about what might happen next. And here, it's convenient to use the survey of monetary analysts, which, by the way, we started releasing this data set. The ECB have been running this for a while. We now, 9 days after the monetary policy meeting, the Friday after, we put the answers on the web. But it's a good data set now. If you want to ask, well, what does the world of ECB watchers, what do they think? Because they give quarterly forecasts. We don't provide quarterly forecasts. So for many data set purposes, it can be interesting. So what I show here on the left is the year up to Q1 22, which is the last complete quarter we have. So that's already happened. So the blue line is what's already happened. And in that year, to the end of March, inflation was just above 6%. Now, when you look forward to what's going to happen next, the survey of monetary analysts, the median thinks another year. So between Q2, where we are now, and Q1 next year, that 12-month period, the cumulative inflation over that time period, so the change in price level, will be less than 4%. So dropping, but clearly not dropping all the way back to 2%. But then from mid-23 onwards, it's basically around 2, if not a nudge below. So the survey of monetary analysts, when we asked them in April, when we asked them in April, their assessment was there's not another year in terms of momentum where inflation will be above target, but then it will settle down more or less around the target. So again, you might think of that as being part of an adjustment phase. That if you ask the world to absorb what's happened with the energy shock and related shocks, it doesn't all stop in one go. There's second round effects, there are dynamics. And here, the assessment has been another year. You might say, well, how does this look like other charts of inflation? Because remember, the convention often is people will say, well, in July, the inflation rate would be X. But they're comparing July 22 to July 21. And a lot of that has already happened. So what I do here is the change in the price level. So there's no overlap here. Each is a non-overlapping period, whereas when the monthly inflation rate comes out, there's a big overlap with what's already happened. So this can help maybe think about it. And then in terms of core inflation, it was high 2s until the end of March. And again, the projection is it'd be a little bit above 2 for another year, but then settle down. So until recently, at least, the analysis was this is a burst of inflation. It's really big. It's going to take another year to run through the system, but then it's going to settle down. Okay, so then the question is, where is it going to settle down? So what I show here, and again, for central banking, it's important to think about, because monetary policy works with a lag. So where we think inflation is going to be at the end of the projection horizon plays a particular role in setting monetary policy. And what I show here is going back to 2018, and the blue line is headline, which is basically 28, in none of this recent history, and in fact going back further, did we think inflation was going to hit 2%, even 2 years ahead. So the end of horizon in projected inflation, we've had this persistent issue where, because we're near the lower bound, there's a limit to how much we can accelerate to pick up in inflation. The whole time period until recently has been a period where the diagnosis is you need a lot of monetary accommodation because we think inflation is only going to improve very gradually. And in the pandemic, this dropped quite a bit. So we assessed with what I said earlier on, that to be more and more slack even when the health crisis would be over, the recovery would be incomplete. That we assessed that there was a risk that the 2-year head inflation rate might be as low as 1.3. So a lot of the rhetoric about the PEP was, let's restore the pre-pandemic path, and then after that worry about 2%. And of course, what's happened more recently is this has been revised up. So in the big jump was from September to December, from about 1.5 to 1.8. Marginal adjustment in March to 1.9. But basically now, whether it's 1.8, 1.9, or whatever it's going to be next week, it's more or less around the target. So having inflation in the horizon settling around the target is a very different world to the world where inflation was projected to remain well below target essentially indefinitely. Okay, so let me. I've tried to just give you the picture of inflation, and then when we try and think about what's driving this, I think that there are 3 shocks which obviously interact in a lot of ways. One is what I call the pandemic cycle, because the pandemic has cycled through different effects. One was, of course, the shutdown of the world economy, the European economy, and that I think produced the deflationary effect we saw initially. Second has been the reopening, whether there was a reopening in Q3 2020. So after the severe lockdown, we did have a significant bounce back then. And then really since the vaccines came along a more persistent cumulative reopening since then, but of course with lots of cycles. So then in the second half of last year, there was a lot of discussion of bottlenecks, that the pandemic was operating, the reopening was operating on the demand side, but on the supply side, for all sorts of reasons, there were bottlenecks in various supply chains. The third component is really maybe very visible now, which is the more complete reopening of the services sector. Any of you tried to book a holiday, book a restaurant and so on, there's now a more long-term reopening of the services sectors, but of course the workforce in many categories have at least temporarily disappeared and there's a lot of mismatch there. And then the fourth component is essentially the longer-term impact of the pandemic on balance sheets. So again, there was a lot of time spent worrying about corporate vulnerability, that the losses during the pandemic would mean the corporate sector would be very weak for a long time. Of course, a lot of that was offset by various types of fiscal action, but not entirely. Households, whether through the fact of being unable to consume, and also, depending on the country, fiscal transfers, of course, household balance sheets look very different now than they did pre-pandemic, and the sovereigns have also seen action on their balance sheets. So all of these I'll come back to in some charts in a couple of minutes. The second is the energy shock. So again, in the first half of last year, more or less, the assessment was the recovery in energy prices was just in line with the world economy. It's just with the lack of activity in 2020, where the oil price was dropping to about $25 in autumn 2020, a considerable pickup would just be simple bounce back. But in the second half of last year, I'll show in a chart that there's an assessment that there's also been supply disruptions. And so there are supply issues, not just a demand driving energy prices. There's also, lurking behind all of that, a debate about how much of this can be connected to the transition, with some countries moving away from coal towards gas, raising demand for gas, reducing the responsiveness, for example, of shale to high oil prices and so on. Many factors there. And then, importantly, for how the energy shock shows up in the euro area context, the fact we're a big importer of energy means it's a terms of trade shock, which makes it quite different to some other countries. And then the third component, of course, is the war. Now, at one level, it's amplifying the energy shock. It's to a degree amplifying bottlenecks in certain categories. But then in terms of extra macro channels, it's a big uncertainty shock for the European economy, which I'll show. And of course, there's many debates about what it means for the longer term geopolitics, longer term issues with respect to globalization and so on. So let me come back to, again, the key issues for us is you can talk about these shocks, but what really matters is what is the dynamic adjustment? Are some of these essentially level effects, which might be pretty big, which might take quite a while to fully pass through the system, but eventually will, versus how much of this is basically going to change the long-term dynamic of inflation. And then that's a global debate. And the additional factor for the euro area is, to the extent there's a big difference to re-anchoring inflation expectations at 2% from below versus de-anchoring to above 2%. And of course, for other countries where inflation expectations are already anchored, the risks is entirely to above target outcomes. For us, at least in part of this was maybe to bring us towards the target, not necessarily above target. Okay, so I'm going to race through a few charts here, and again, in many ECB publications, there are more details. So one is just to make the point about the oil price dynamic, which is when the ECB staff tries to make a decomposition, what you can see here is the red line really kicked in from last summer. So there's been a bunch of factors there which are not just simply the recovery in world activity there are supply issues in the energy market pushing up prices. And again, some of the questions here is how much of this is temporary bottlenecks, some issue here, some issue there, versus how much of this might reflect other factors. The terms of trade issue for Europe is important to think about. So the left side shows the trade balance for the euro area. The blue line shows you the goods trade balance, which includes energy. And from kind of knocking around 2 to 3 percentage points surplus, it's now around a minus 1 percentage point deficit. So that 4 percentage point turnaround in the trade balance, you might think about in terms of the income effects of that. On the right side is a calculation which only goes through the end of last year, so it doesn't have what's happened this year. And it basically says if the only world price that was moving was the energy price, it would amount to about a 4 percentage point hit to European real income. That's a very large macro shock. Now, for Europe, there has been an offset. European firms are also achieving high export prices. Think of the car companies, even though production's lower than normal, their prices have been quite high, is one example. And of course, Europe produces many manufacturing goods, or I should say the euro area produces many manufacturing goods. I won't talk about the UK in relation to manufacturing exports, and the high prices for that does mean the overall terms of trade effect is less, but is still significantly negative. Okay, so now bottlenecks. So again, at the last part of last year, start of this year, this was a big debate. Bottlenecks disrupting the goods market. Now, the issue with bottlenecks, so this is supplier delivery times. And again, when people try to make a decomposition between demand and supply. What you see last year is that the delivery time got just longer and longer and longer. And again, of course, this is a strong demand recovery. And this is why the supply-demand decomposition is important. Because in principle, it could all be just demand. Because in fact, the logistics firms, many shippers have had a very strong last year. So there was a big response in many ways in terms of logistics. But there was also problems, including, of course, many factories in Asia were under lockdown at different points. So there really was actual supplier disruption. And so anyway, the assessment here was that this was getting worse, but then we felt this year it would get better. And from October, it was getting better, but actually it's dipped again recently, which may have either to do with the China lockdown or with the war to some extent. But the point here is with bottlenecks, the presumption is eventually these get worked out. High prices create an incentive to solve these bottlenecks. And if prices are high because of lack of supply, when more supply comes along later on, it would put a lid on inflationary pressure. Now, I think that's true, but maybe I'll come to the quantification of that in a minute. So on the left side is goods inflation, and again, when we try to work out what's going on with goods inflation, the orange box is this bottleneck factor. The red box is the spillover from oil prices. Many categories use oil as an input, so prices of everything go up when energy prices rise by enough. And until recently, you might say most of the rise in goods inflation can be attributed to either bottlenecks or to the spillover of oil. So if you look at the kind of late last year, early part of this year, the fact that about 1 percentage point could be attributed to either bottlenecks or oil would suggest, well, once those the bottlenecks get sorted out, once the oil price levels off, then this extra inflation goods markets might level off as well. But you can see in the most recent readings, including yesterday in May, it's still maybe adding 80 basis points to goods inflation, but other stuff is going on now. So it's not just bottlenecks and goods inflation. So these are deviations from the mean, and remember the mean for goods inflation is quite low historically. But the narrative is there. These are still make a difference, but they're not the majority story maybe in the most recent data. And then the right side tries to say, well, services inflation can also be connected to oil prices and to the pandemic, because many services use energy, transportation services, hotels and restaurants, travel, they're all big energy users. So it makes sense that there's also indirect effect from high energy prices and services. And the reopening does mean in those sectors which are reopening, high contact sectors, it makes sense at the point of reopening there might be increase in prices because prices were very low. Just think about airfares, holiday prices, lots of discounts when you could not enjoy them during the pandemic, and now there's a rebuilding of prices. But there is that connection there. But let me, I suppose, in the end conclude here, is you can point to these factors. And again, with services inflation, other factors are becoming more important. So there is maybe a transition in the nature of inflation from some of those initial factors to a different discussion. Okay, so you're going to have to tell me how long I have, Beatrice, because I can speed up or slow down.
Speed up.
Speed up. Okay, so I'm not going to talk about the GDP side of it. Well, tell me exactly, 5 minutes?
Okay, 5 minutes.
5 minutes. Okay, you can, the fact that the macro side, I've talked about before, so you can catch up if you need to. So let me go to the key issue first now, is the narrative of a lot of this being temporary, a lot will fade away of its own accord, and in fact, in the euro area context, what are the risks to this outlook? So let me make a few points here. One is something that hasn't really happened yet, but is going to happen to some degree, is a catch-up adjustment in wages. So let me emphasize, there's a very big difference between catching up on unexpected inflation that's already happened versus wages going up because they think that we're in a new world of inflation being high indefinitely. And I think that's straightforward. But let me make 2 points here. It is the extent of that, especially in the context of a terms of trade shock, and the speed makes a big difference. If you think of any model where momentum feeds momentum, spreading out the catch-up over several years makes a big difference to the medium-term inflation prospect versus a very high rate of indexation, for example. So I think that can be straightforward. Then a very big issue, and many debates boil down to what determines long-term expectations. Is it what's just happened versus a more broad perspective, which also takes into account the fact that we yell 2% all the time and other factors. And then let me say is not everything boils down to longer term expectations. There's also a phrase called inflation psychology. And the inflation psychology, in principle could be something that even if people say, I fully believe inflation will go back to 2%, but right now, I believe inflation is everywhere. And, what's interesting about that is in the ability of firms to raise prices is, I'm sure, heavily influenced by this inflation psychology point. But let me point out here is there's two versions of that. One, it just means inflation will be more intense because every sector is adjusting quickly. But it could be quite intense, but not necessarily long-lasting, if it just means all the pass-through happens quickly, and then it's over. Versus if it feeds into a longer term, the anchoring. Okay, then I'll skip the long term, but then the last one is interesting because many people right now are concerned about the real interest rate channel, which obviously goes to monetary policy, If you have nominal rates which are low and expected inflation that is high, then the belief there is it's a destabilizing factor. It reinforces inflation pressure because of the fact low interest rates should jack up consumption, should jack up investment, jack up credit, and so on. So maybe, now of course, there's 2 points to notice here. One is, for that to be a kind of first order issue, you have to have a big elasticity of the economy to real interest rates. And also you have to take into account, tell me the environment. So in a world where you're super optimistic about the future and you present with a very low real interest rate, is very different to an environment where there's maybe reasons to be nervous and have a super low interest rate. Okay, I'm not, because I do want to allow time for the panel, I'm not going to go through those ones because, let me stop here because this is a new chart. We've been presenting the Consumer Expectation Survey, and we did report in March a big jump. In the latest data, which is just out now, or it's not out in the sense of we don't, but it's out. I'm outing it in this chart. There's been it's still higher than it was, but a little bit of a decline. I'm not making anything of the little bit of decline, but at least it's not accelerating. Wages, I've shown this version of the graph before, which is interesting. Wages are picking up. So the green line is what the wage contracts being signed now, and they're around 3% for this year. But what's interesting is in multi-year wage contracts, it's 3% this year, 2.5% next year, which is in line with a belief that this is a kind of a temporary phenomenon. It's not the case. They need to build in rising wage adjustments so far. Okay, let me jump. Those are just descriptions of the interest rate, but let me go to the real interest rate point. So one is financial conditions cannot be summarized by the OIS. So here I'm flashing up, and you can look on the slide deck in more detail. It's on the ECB website. All sorts of financing conditions are moving. And remember the connection from the OIS to sovereigns and from sovereigns to here on the right to bank bonds. It's more than 1 for 1. So there's there is a kind of rescaling of financing conditions in the area. But let me focus on the real. And so the blue line is the term structure of forward rates. So the real rate 1 year from now, 2 years from now, and so on. The blue line is December, before we started adjusting, and then you see what's happened now. And what you see, there's been a pretty big increase in real rates. Big in this chart, but minor maybe, of course, in terms of other scaling factors. But it's not the case that the real rates are becoming more negative, because there has been a movement in financing conditions. So it's not the case there's been a kind of a worsening of real rates. And you can see at the long end, it's around 140 basis points. So that's a fairly significant movement in real rates. Now, I'm not saying this is everything that needs to be done. So let me stop on that point. Is with that scenario, what I've been saying recently is it's robust to start normalizing, regardless of whether you think it's an episode that's going to settle down relatively quickly to 2%, or other scenarios. It's robust to make the initial steps to normalization, to validate the tightening that's already happened in many financial markets. After that, given the uncertainty in the world, there's essentially all sorts of scenarios, and that's why we do emphasize gradualism. So maybe I'll stop there, and sorry for not managing the time. So, okay.
Thank you very much, Phil.